Our time has started, just as an FYI. Sorry, I don't mind, but I know this little, I know, it is very strong. Do you want me to ask them to lower the lights when I get from the back? Excuse me, can we lower the lights slightly over here? Let me start out by saying thank you all for attending the session. My name is Robert Bruno, and I'm the president of First Eagle Funds Distributors and head of First Eagle Funds Sales Force. Once again, I'd like to thank you for attending this session. The session is assessing the macroeconomic climate and advising clients. And we're lucky to have two wonderful speakers here. Like me, I'm sure you're very interested in hearing from them. This should be a great session, and we're going to try to get started as soon as possible. First Eagle Funds hopefully is not a name that you're unfamiliar with. I hope you're familiar with it. I've seen many clients in the room. We've been around for many, many years. We're known for our global value philosophy. We did have something new happen this year. For the first time in 10 years, we've actually launched a new fund. So we're very excited about that, our high yield fund. So please come by our booth and get an opportunity to hear from us. We're very, it's a 5-star Morningstar fund. It comes with it a 4-year track record, so we're not launching something from nothing. We have a substantial team that we've been able to recruit. We launched it early this year. As I said, it's a 5-star Morningstar fund, and for 3 years, it's a Lipper leader as well. So we've heard from many of our clients that over the last few years that they'd like an income option, and it took us a few years. As you know, First Eagle doesn't do things quickly. We're very prudent with regard to our decision making. So we found this team earlier this year, and we're able to recruit them and to start this fund. So it's an exciting opportunity for us, and as I said, it's the first time in 10 years we've done this. So we're excited. Hopefully you will be too. So please come by our group and our booth and get an opportunity to hear from us. This will be an excellent session. Obviously, it's a topic of interest. It's the last actually breakout session of the day, so we've saved the best for last. To give you a little insight into how the session will go, each of our speakers will talk with prepared remarks for about 10 or 15 minutes each, and then there'll be a Q&A. We have two of our people in the back, Mike Furlong, who is our Western Sales Director, and Mike Biondow, our Northwestern Sales Director. They'll be on opposite ends of the room. They will have mics, so for the benefit of everyone here, if you could wait till, just raise your hand. They will come to you, and then please speak into the mic so everyone gets the benefit of your questions. It's a little bit odd for First Eagle Funds, given we're bottom-up investors, to be moderating this session, given the fact that it's assessing the macroeconomic climate and advising clients. But obviously, post-2008, one has to be fully aware of the macroeconomic environment and be able to respond to that. And I think we'll get a lot of great insight and advice from our speakers today. So without further ado, I'll introduce each of them so that we can start and you can hear from the people you'd like to hear from. I'll start with Lori Van Dusen of LVW Advisors. Many of you know Lori. Lori is a CIMA and has been providing investment consulting advice to institutional and private clients for 24 years. Prior to forming LVW Advisors in 2011, Lori was with Convergent Wealth Advisors. Previously, she was a managing director with Citigroup Smith Barney Institutional Consulting, where she began her investment career in 1986. Lori's leadership has been recognized across the industry's print media. Since 2004, Lori has been consistently ranked by Barron's among the top 100 financial advisors. In 2011, Lori was named was recognized on Barron's top 1,000 financial advisors state by state, and was ranked 3rd on Barron's list of the top 100 women financial advisors. She received her master's from Harvard University and graduated magna cum laude from Ithaca College. Next to Lori is Margaret Black-Scott. Mag, as she is known, is the CEO and president of Beverly Hills Wealth Management, a firm she founded after a 30-year career with Morgan Stanley & Company. Formerly a managing director and vice chairman of Morgan Stanley & Company, Mag started as a financial advisor and subsequently became a branch manager, a regional director, and then division director for the Western United States. A former adjunct professor at Jacksonville University, Mag has given financial and estate planning seminars all over the country. Mag received a degree in business administration from Rotherham Technical College in England. She earned her MBA at Jacksonville University in Florida and completed postgraduate work at the Wharton School of the University of Pennsylvania and Harvard Business School. So please welcome Lori and Mag. And Mag will start.
Okay, thank you. Thanks, Robert. Oh, I'm mic'd up, so do I need to use this? Yes? Yes, okay, thank you. All right, let me have my great big, I have a 300-slide presentation for you, but I consolidated it to that. How's that? Okay. I want to start by thanking Sterling Shea for inviting me here again to Barron's. It's always a pleasure, and Jenna Sabia is just brilliant to work with. And I have to say, this is the best dressed group that I have addressed for a long time. I'm so happy to see professional people looking like professional people, so congratulations. Now we're going to assess the macro environment and advising our clients. What do we do with the information that we have out there, and why do we need to make sure our clients understand the basics so they can understand why we make the recommendations to them that we do? Let's face it, there are only three things you can do with a dollar. You can spend it, lend it, or own something with it. Spending is easy, especially in Beverly Hills. Lending it, clients don't understand that they're lending money anytime they have money earning interest. We need to make sure that they understand that. And then ownership of companies, ownership of assets, ownership of different blends of the asset allocation model that we put together for them. So let's take a quick review around the world. We know that clients are anxious because we've got $10 trillion sitting in cash as of Monday of this week. I wish it were all in Beverly Hills Wealth Management. Clients want to know where to invest and how. They want safety of principal and of purchasing power. They want growth of principal for purchasing power. So as we go around the globe, we'll start in Europe, then we'll go to Asia. Prior to that, we'll drop down to Africa. We'll continue on around to Central America a little bit, and then to the US. So I need your high-speed ears, because Robert took all my time. No, just joking. Let's start with general definitions. From the start of a recession, it takes about 4.5 years for unemployment to hit bottom. Then it takes 4.5 years for GDP to normalize. Thomas Jefferson said that debt will be the ruin of every great nation. That governments will default is a given. It's a standard pattern. Let's look at the past 200 years. Greece has been in default 50% of the time, every other year since independence. Since the Great Depression and World War II, many European countries have defaulted, and most of Latin America, with the exception of Argentina, which defaulted prior to the start of World War II. In 1942, Japan defaulted. India has defaulted 3 times. And in case we're feeling really smug about it here in the United States, we have defaulted twice. In 1792, but Hamilton being the great Secretary of the Treasury that he was, he paid off his debts, but not paid off our debts, our ancestors' debts, but not 100 cents on the dollar. And then when FDR took the U.S. off the gold standard in 1933-34, that was a de facto default right there. So it happens to everybody, and it's not that unusual. Countries grow out of defaults, but no one has outgrown a banking crisis. Equities peak to trough, down 56%, then back up to the old highs and through. Let's take a look at Europe. It's a mess. If we take away the euro, it's just business as usual, as a matter of fact. The euro has tied everyone's hands. Many debts will not be repaid. Smaller countries will likely be cut out of the Eurozone, and probably the warmer countries, Greece, Italy, Ireland, which is not a warm country, but still it's in the group. 1,000% of its GDP is debt. Portugal and possibly Spain. It is my opinion that we will see a bifurcating of the euro. We'll have the cold countries that are very serious about their money, and we'll have the warm countries that like to sit on a beach and drink, and they'll be the lower euro standard. Germany's stuck in the middle supporting all of the Eurozone because they loaned money to buy German goods and services, so they don't have a choice but to buy the debt. That's just the way that it is right now. So it's obvious within that that there is a European banking crisis of great proportion. When banks trade below book value, it means there are hidden losses. Keep that in mind when you're looking at our own stocks within the U.S. Banks don't recover until they've had the last rites. Currently, there is no strong bank in Europe. The countries are broke, the banks are in trouble. What about recapitalization? When they recapitalize, that in itself can cause collapse because then they write off the bad loans, shrinking the capital that they just raised. So think about that. The IMF is a bridge loan mechanism to cover a bank run, but again, the countries themselves are broke. In the U.S., we have flooded dollars over to the Eurozone because we have no choice. The risks are huge for our own economy. European banks have a tremendous presence in the U.S. and in Asia. So we've essentially done our QE3 via Europe. 57 billion was the last number that was given. The social policies of Europe, how are we doing? Okay, thank you. The social policies of Europe have brought it to this, and make no mistake about it, if we don't amend our own ways, we're looking at the same thing here in 7 to 10 years. In 2000, we had $6 trillion in debt and a 6% interest rate. Now we're at $15 trillion in debt and 2.3% interest rate. In 2000, we needed 8% of tax revenues to cover debt. By 2020, that number will be 23%. Simpson-Bowles was established to eliminate write-offs and generate meaningful tax reform. Now, centrists in both houses understand that. Who won't accept it? The general public won't accept it. So we have major issues. Let's take a look in Africa. They've got different issues than we have. Africa is a huge continent with many different countries, but overall, they are growing at 7% a year. Emerging countries operate in cash. They have prepaid phone cards, they pay cash for cars versus the 92% of automobile purchases here that are financed. China is in Africa building out its infrastructure. But what's the dream trade if you're in Africa? It's America, it's the United States. Countries around the world buy into the dream. We must never lose sight of that ourselves. McDonald's, Starbucks, hotel chains, they are on the front lines of taking the U.S. into these countries. African countries have gold, they have diamonds, they have commodities, they have minerals. And I want to throw something to you right now for us to think about over the next 12 months and think seriously about it. And when we regroup here, we can have a different dialogue a year from now. Should we consider minerals to be a separate category for investment, a separate asset class? Think about that. We're going to talk about gold for a while. The Chinese can now buy gold. Indians always could, but now they have greater wealth, so they're buying more of it. In Syria, women cannot have a bank account, but they can own gold. So is gold money, or is it an investment? 2,600 metric tons are produced annually worldwide. Central banks worldwide are now net buyers after 20 years of being sellers. The swing started to occur in 2009. In 1980, they had 60% of central bank reserves were in gold. It dropped down to 15% by 2008. It's just now beginning to increase. Chinese miners are the largest in the world. Chinese government buys all of it, plus it imports all that it can. ETFs own $72 billion worth of gold, which is the fourth largest owner of gold in the world. So is this the beginning of a gold standard? It's certainly better than fiat money. Fiat systems have not worked in 5,000 years. But you know what? In 5,000 years, politicians in all eras have been and remain predictable. So what do investors want? They want long-term sustainable growth with minimal inflation, and a gold-backed system may be the least imperfect. China wants the yuan to be the reserve currency. That would indicate that they need over 20,000 tons of gold. Either that or it needs to be priced at $27,000 an ounce. Even the most aggressive gold bug, I haven't heard them say that it'll get that high in the foreseeable future. The U.S. needs the price to be between $7,000 and $8,000 an ounce in order to back M2 by 25%. So compare the two currencies, gold versus paper. $160 billion a year of gold is produced versus $1.4 trillion of U.S. paper currency created annually to cover the annual deficit alone. Which currency do you want to own long term, and what is your advice going to be to your clients? If you're advising them to own gold, say 10% of their net assets, in the event of a currency meltdown, think hard about whether you're looking at a mutual fund, an ETF, or physical gold. Roosevelt, Hitler, Mussolini, and Stalin all confiscated physical gold. So if you are recommending that to your clients, you have storage issues to address. Gold mining companies look pretty cheap in here. They're operational, and there are risks. There's no question about that. But I think that we're going to see quite a number of takeovers over the next 12 to 24 months. As for China itself, remember we were talking about China in Africa. Now let's look at China. Growth is slowing from 12% to 7.5%. That's their objective for this year. We generally consider it negative because they've been on such a binge, but it is still moving forward. Now China's building airports, highways, railroads. Railroads, they're laying 24,000 miles of track a year. They've had a couple of black eyes in the past few months with railroad accidents, but they're still moving ahead. They need rail, but there's massive corruption there. The Chinese Politburo is now focused on corruption. The roads that have been built out over the past 10 years, by the way, are greater than the entire U.S. interstate system that we started to build in Eisenhower's years. What about a housing bubble? Yes, China's wealthy cities are candidates, given that there's been massive growth and no stall to date. But look at where they're building now, next to highways and next to railroad stations, so that they can take workers who are coming in from the western part of China, and they're scared to death of a feudal uprising, as you know. I think there was something about it in yesterday's news. They're giving them jobs. They're giving them somewhere to live. So they are building the future wealth of the nation. Again, there's a lot of corruption in real estate. There's a lot of corruption generally across China, especially in Macau. But we knew that, didn't we? They tolerate Macau right now because it allows people to launder money. There will come a time, probably 2 or 3 years out, when that will change, and then they'll truly get serious about corruption. So we have still opportunities there for a couple of years. China now needs to mobilize its capital and move from labor to capital. There's a tremendous savings rate by the Chinese, but they have a negative 2.5% negative yield on $5.2 billion in accounts. Chinese shares are moving up 2% a day. Now, they're the Chinese shares that the Chinese buy in China. They're not the ones that we can purchase. We've seen a manufacturing revolution microcosm in China. The price of automation has collapsed human labor. Any job that doesn't take creative thinking will be automated. For instance, Coca-Cola went from 5,000 workers down to 40 in China. If we go across to Japan and we look at Panasonic in Osaka, Panasonic, remember, makes 10% of all large screen TVs. They run that with 15 workers. Robotics, again, a place to look. What about the little country that is between China and India, Burma? Thanks, Robert. Burma is gaining in importance as we are seeing the leadership starting to open up a little. It was once the leading supplier of rubber and of precious gems. Remember, these countries have so much of their treasure is still in the precious gem market, and that is how they trade across Asia. I have an informal survey, at least that's what I always tell my husband. I have the Sotheby's jewelry catalog that I have subscribed to for years, because you can see the movement of prices up and then the movement of prices down. And the biggest markets are, of course, out of Hong Kong and out of Shanghai now, because people want to transfer their assets. But back to Burma, Myanmar as it is now known. It started exporting since 2002 beans, dried beans. It exports lentils and chickpeas to India. That business has now grown to $800 million a year. They're easy to grow, they're cheap, and they take little fertilizer. I don't know of any way that we can currently invest in Burma other than probably through some smaller cap mutual funds. But our great need and challenge is to invest in improving human capital and the integration of the Asian economies into the worldwide economy. If we come back around to Central America, we have tremendous problems with the drug trade, as you well know. President Uribe in Colombia is doing an enormous amount of work going literally village to village, town hall to town hall, to try and win back the hearts and minds of the people. At such time as the Central American countries can become truly trading partners of ours, that will be huge. In the meanwhile, the growth of the Panama Canal is going to change transportation for all of us. Back to the U.S. You with me so far? Okay. The long-term wind is at our back for value investing. Yes, we've got volatility. That, I think, is just a factor of life going forward. But we're seeing industrial activity pick up, although there are issues. We've seen a tremendous increase in transmission and distribution for utilities. If we look at our latest 60-year history, following World War II, we built the industrial military complex. And then in 1957, we had a world-changing event. The Russians launched Sputnik. Hello, what are we doing? Are we going to be attacked? John F. Kennedy launched the space program. He announced the U.S. space program. Look at the multiple spin-offs that we have had since the origination of that in 1961. The computer that took men to the moon, I'm sorry, I've got allergies. The computer that took men to the moon had 35K memory. What do you have in your phone? Just amazing. So we are seeing the speed up of technology. We're seeing the speed up of so many different things. In 1973-74, President OPEC quadrupled the price of oil, and President Carter said, we're creating a Department of Energy. We will be energy independent in the decade. Well, hello. We still don't have it, but we could have it. We'll talk about that. But we have a bureau of thousands of people consuming $9 billion in tax dollars each year. In the time from 1945 to 1980, the U.S. had the time and opportunity to become a stronger economy. But instead, we became the #1 service provider, so we have fallen behind in education, and industry also is allowed to decline. I'm running out of time. Okay, I'm really running out of time. So you don't have time to hear my brilliant thoughts about natural gas and oil, but Lori is so wonderful that we really have to hand over. Thank you, Bob, for giving me this signal. It's not you, it's me. Thank you, Lori.
I'm going to sit here so you can turn on the mic. I'm going to try to, I think, in about 10 or 15 minutes, take some of what Mag just outlined and talk about the macroeconomic climate, some of the opportunities, some of the worries, and how you kind of distill that down in our practice, how we've distilled it down into advising clients. I think it's probably fair to say that most of us have had clients coming in our offices or going to them where they are concerned. We've had, a little bit about our practice. I won't get into it too much, but we have 37 clients, and they range in size. They're probably on the bigger end, but I would say small to mid-size institutions and families from $10 million to about $600 or $700 million. We have a model where we really advise to the whole client, but we're hired as, for lack of a better way to put it, an outsourced CIO. And then we access strategic partnerships to kind of solve organizational problems and planning problems, et cetera. So we have some really sophisticated clients who are in the business, who sit on investment committees and grill us all the time. And then we have clients that we've had for 25 years who are kind of the kitchen table clients who just kind of the wealth has grown and accumulated. And so the degree of sophistication is kind of all over the place. So we've had to try to figure out how do we present to both of those kinds of audiences. And I think one of the big challenges right now is, even we had a meeting a couple weeks ago at Cornell University, and very sophisticated investment committee member said, after last year, our clients did not make a lot of money last year. I don't know about yours. And some of them were slightly down, depending. It's really tough to take the macro swings. And we had a very sophisticated client say, how long is this going to go on for? Can you just tell us how long you think this is going to go on for? And I think, what clients are looking for is for us to have confidence in what we're recommending. And I think the only way that we can have confidence that the investments that we're recommending are going to help our clients better achieve their goals is to really think about the macroeconomic climate and then be pragmatic about it. And so I'm going to go through, actually I don't have the clicker thing. I'm going to go through a couple slides. I'll probably fast forward through some of them. And I know in the back you can't all read all of this, so don't worry about it. I'll speak to most of it. So we have a base case, and it's probably conventional wisdom, which always scares me, but global growth certainly has come down in the short to intermediate term. There is a recession in Europe. It's worsening in the periphery, as Mag kind of outlined. There is a slowdown in China. China's a complete wild card, as she also outlined. We have below trend growth here in the U.S., which is likely to last for quite some time, which you also alluded to. It's not a huge step. We don't have to do over-analysis to kind of get to that conclusion when you have an unemployment rate that's as high as it is. If you look at the peak to the trough of the recession, we lost something like, I think, 10 million jobs. We still are down 7 million, and just with population growth, we have to add about 1.5 million jobs a year, not to mention the people who stopped looking, who at some point will start looking. So it's this huge mountain that we have to kind of try to climb up. So getting back to something like 4.5% unemployment, as resilient as this economy is going to be difficult. Greece is ring-fenced for now. The LTRO was a game changer. They definitely, I hate this term, but they definitely kicked the can. It's very clear that I like to say Europe's gone chronic. Instead of being in a crisis, it's gone chronic. The problems aren't fixed. I don't know what's going to happen in 3 years, but for now, there's been a lot of attention on it. So our kind of base cases, things are somewhat contained and ring-fenced. The emerging markets are going to benefit and have from all this liquidity, which is going to continue. It's going to be very volatile there, we think. And you'll see in a second that we don't think valuations are extraordinarily cheap there through February, March. And I guess all of this makes economies in the developed world really vulnerable to anything coming out of left field, or maybe not even left field. The Middle East is heating up. There can be a shock coming out of anywhere. So while people who know me know I'm an optimist and a pragmatist, it's a little scary, and I've been doing this a long time, and I think it's okay to say, look, there's a lot of uncertainty, but it's also okay to say, here's how we think about your portfolio, here's how we think about your situation, and help clients take some control of the uncertainty. So here's a chart you can't read. I know you can't read it. You're not supposed to be able to read it. But what you probably can see, and if I had a laser pointer, I could show you, there's a peak in the middle, that's 1987, and there's 3 peaks at the end, that's the last 3 years. These slides should be available through Barron's, and I think they've been helpful to us in talking to clients about this. Last year was a year obviously driven by the macroeconomy. There was not a lot of fundamentals that were pushing equity prices. And what this shows is the correlation of S&P stocks to the S&P index. And what it means when they peak is that they're trading in a lump, that fundamental factors really aren't, there's not a lot of disparity between the way stock prices are moving. So the long-term average going back to the early 70s of the correlation of the S&P stocks to the S&P is 0.46. It reached the highest level last year. So I use this to say to clients that are really sophisticated and clients that are our kitchen table clients, as I call them, long-term clients, look, the one thing that tells me is that this won't last forever. I don't know when it's going to stop. I can't answer that question, but it's not going to last forever. You probably can't read this either. All this says is that last year, as you probably know, the most defensive sectors were the most expensive going into the year. By the end of the year, they were even more expensive: REITs, utilities, telecom. We simplistically use this for all clients, and we use this chart for institutions and for private clients to talk about where we take on beta, where we overweight and underweight based on valuations. And our process is a little bit more sophisticated, I guess, than this, but I think this is a really helpful chart to look at kind of where are we. And if you study it, really simply, if you look at the Russell 1000 growth, and this is updated through February, and you look at the S&P, if you look at PEs, forward PEs versus historical averages, they're trading at 73% and 76% of long-term averages, which is pretty cheap. If you go across the page, the most expensive, relatively expensive part of the world markets are small caps. The emerging markets are actually the most expensive. So this helps in talking with clients about kind of worst case scenarios or expected scenarios, our base case. So if I said, look, I don't know what's going to happen, but if we get pulled into another recession here, or if earnings are just too darn high, let's whack 20% off earnings, what would happen to valuations? What you walk away from in this very simplistic, I know, analysis is that the Russell 1000 growth stocks, large cap growth stocks, tech, healthcare, and the S&P are still pretty cheap. And the developed world outside of the US is cheap too. So if you could invest in large growing companies that productively use their cash anywhere in the world, it's probably not a bad idea. Why? If you're a long-term investor. So the next question that a client might ask is, well, if stocks are that cheap in certain segments, what's going to happen over the next year? And I didn't cite this. I noticed this morning. So our friends at JP Morgan Asset Management actually did this. If you look at the PEs as a predictor of one-year performance, you again don't really need to read this to know that this chart on the left, there's zero correlation between PEs and what happens over the next year. And it's all over the map. But if you look at 10-year periods and you go back to 1952 and you could buy at the current PEs of what we just looked at, the Russell 1000 growth and the S&P, if you could buy at earnings at 11, 12 times, the average return in periods where you bought stocks at those valuation levels was worst case 5% annualized over 10 years and best case 25%, and on average about 18%. So that's great, right? So we can say, geez, if you're a long-term investor and you can pick stocks well, or you can just buy cheap stocks, you probably have a high probability of having a pretty good return over the next 10 years. But then we all have to blindfold our clients and tell them not to pay attention for 10 years, and that's not very pragmatic. So here's what we do. Another simplistic chart that we show clients, based on all of what we just looked at, where are we overweight and underweight in your portfolio relative to your strategic targets or where you would be on average. And so just really very quickly, we are overweight those high dividend, low payout growers in the large cap space. This was as of December 31st. What did our portfolios generally look like? So for our clients' beta or growth assets in the equity markets, we were overweight large cap, very underweight small cap, overweight developed non-US, neutral to the emerging markets, et cetera. The bottom part of the page, multi-strategy, fixed income and cash is what we consider our more defensive part of the portfolio. We're underweight fixed income. I think it's a very overvalued asset class. And we are kind of neutral this area we call multi-strategy. Multi-strategy is a bucket of a lot of different things, but senior bank debt, emerging market currencies of fiscally stronger countries, some high yield. We kind of favor, where's the first eagle, I'm sorry, but we kind of favor senior bank debt over high yield, but we also have some mortgage backs in that whole category. So I've got about 5 minutes. So we always talk about, in our investment committee meetings internally, what if we're wrong about our base case? So I kind of went through the middle of the page, kind of what our base case is. And we think about things in terms of, the short term and the longer term. And we want to talk through the possible scenarios and the most probable scenarios and what are the implications for our clients' portfolios. And I guess we want to try to find things that we think the worst case is almost priced into, and then also ask the question, where are the opportunities, no matter which of the scenarios occurs. So I won't go through these because I don't have time, but it would be entertaining to go through the best case because I can't do it with a straight face, even though I'm an optimist. Stress testing, we stress test portfolios, and I'm not going to get in the weeds here, but we do it for both our own edification. When we're adding an investment, we want to know, are we truly diversifying a portfolio, or are we just adding something for the sake of adding it? And under stress conditions or under those scenarios we just looked at, how are our investments likely to perform? Best case, worst case, probable case. And we use this for investment committee reasons, but we also use it with clients when we're trying to get people to consensus around defining risk. So when we have institutional meetings, we don't just manage pools of money in isolation. We're thinking about what could happen to the organization that would impact the investment pools. So in the pension fund world, if we're managing a pension fund, we're thinking about one of the worst case scenarios is interest rates falling like last year and asset prices falling, and virtually every pension fund is worse off than it was the year before. How does that impact our investment pool? How does that impact the liquidity? Where's the money going to come from? So we stress test for a lot of reasons, but the number one reason is we don't want to add an investment that's not going to diversify an existing risk or add something to the portfolio. There's a lot of fake diversification out there. And then lastly, I'll talk about, I'm pretty good. I'll talk about in 2 minutes the opportunities. So there are, I think, several. And I'll start on the left hand of the continuum. There's no slide to this, but the left hand of the continuum would be the safe stuff and more liquid stuff, and the right hand would be the illiquid, higher return potentials. All of these examples, I don't really need to predict what's going to happen in the macroeconomic climate. I think we just have to really look at the investment on its own merit and then kind of stress test it through. So I mentioned senior secured bank loans that we use in our kind of multi-strategy bucket. We also have other things in there, as I said, high yield and some other things. But if you look at the senior bank debt market right now, these are investments that far less than 1% have ever defaulted. The neat thing about them is they're linked to LIBOR, so if interest rates are, if our base case, if we continue to kind of plot along here and interest rates go up and the Fed is kind of talking the talk a little bit now, or kind of backing away from some of the talk, if interest rates go up, we've got something that marks time with interest rates. They pay 5 to 6%, and we're buying them at 90 to 95 cents on the dollar through a manager. We use investment managers. We're not going in and buying them. You have to do really deep credit work. They're senior in the cap structure, and they're collateralized by good collateral. So it seems to us it's a good place to have a part of the portfolio because you have a lot of cushion there. High yield, while I like it, high yield at 5.25% and bank debt at about the same, you don't have the duration risk on. So it's kind of a relative value thing the way we look at it, but we like both. In terms of just the middle of the, more plain vanilla, I talked a little bit about large cap dividend paying companies. Everyone's talking about this. But I think what I would say is that when you go back to those valuation slides I showed, if you could find, we use managers, if you can find an investment manager that focuses on strong corporate balance sheets, companies that are basically going private in the open market, buying back their stocks. High current dividend yields, maybe not the highest, but 2-3% versus the 10-year looks pretty good. Technology, healthcare, refiners, consumer stocks, all trading at those valuations I showed you, 11, 12 times. If you could find that, it seems like it is the place in the market where you could outperform. I don't know about the next year, but it certainly seems like a pretty good bet. So if you look at some of our managers, they own companies like Lowe's, because Lowe's has bought a third of their stock back. They have tons of cash. Stanley Black & Decker, same kind of thing, 10 times earnings, paying 2%, 3%, 4% dividend yields. There's a number of these companies. It's not just an indexing thing, though. So I would say that's one area. If you go to the far right of the continuum, and this is where it gets fun and interesting, I think there are probably a couple areas we spent a lot of time on. One is non-agency residential mortgage-backed securities. This is a really attractive segment of, I'll call it the fixed income market, but it's become meaningfully cheaper over the last 2 quarters to date. It has not come up with everything else. It's a very inefficient space. There aren't a lot of players in it that really understand it. And what I'm addressing and what we're focused on is the distressed senior structures. And those RMBS securities have dropped something like 30% from the peak of last year. And at the same time, there's been no deterioration in the collateral. And so if the housing market is turning or bottomed, it's a pretty compelling, it's a very compelling investment. If you had a virtual U-turn in credit trends and some catastrophe in the housing market, you still have many of these securities that yield to worst after you've done kind of this stress testing and really deep credit work, and there are a handful of shops out there that do it, that are yield to worst, something like 13 to 20%. So we like absolute return and asymmetry in portfolios, and this is one example. It's a $1.2 trillion market. It's one of those areas that kind of hits you, like if you can find the right people who really do the deep credit work and have the flows and are very selective, the key is not to try this, I think. I would never try it on my own, but through an experienced credit team, I think it's very interesting. And the reason it's so cheap has a lot to do with what you were talking about earlier, Mag, which is there is a lot of pressure coming from the European financial institutions. They've just sold everything. And so there's also reduced appetite from broker-dealers. There's a lot of reasons, macro reasons for it, but it's created this very big inefficiency. And these are like Alt-A, pay option arm, subprime type loans. And there's shops like TCW and Double Line, and we use a firm called Canyon that just, it's a private structure. The last thing I'll mention, and then I think we have 10 minutes for questions, is we've done a lot of work on direct lending in Europe. And I don't have to go through all this, but the one thing I would say is that if you look at the European situation that Mag outlined, the banks aren't lending. So I don't need to understand how this is all going to play out to say that the European Central Bank is dishing out $700 billion to these institutions. But if you look at, you're not going to be able to read that, but there's 700 billion euro of non-performing loans just on the bank's balance sheets. So this is a big, huge problem. The banks aren't lending. And historically, I don't know where the slide is, but historically, in Europe, it's very different than the US. Okay, here it is. Historically, pre-2008, most of the lending, the traditional lenders were the banks. So who's going to lend to the corporations? So if you're a provider of liquidity in Europe right now and you're perceived as a local, and there are shops there that have basically bought teams from the banks, and they are buying non-core loans off the bank's balance sheets, which are happening, and you know the good, kind of relatively good banks in the UK and Germany are selling, and then the bad banks can't sell. But the takeaway from all of this is no one's going to lend. So there's a real absolute return opportunity here if you're a provider of liquidity. So it's these are private structures. It's way on the right end in terms of return. But again, deep credit teams, and depending on the client, depending on the size, it's a great way to get a client to feel like they're taking some control out of over all this chaos. So in summary, I'm not going to summarize because I don't have time, but I think asset structure is the most important thing. We do overweight and underweight. I think that there are opportunities out of all this dislocation, and I think you have to think about the worst case in your portfolio, have a view, but none of us really knows. So I think using some of these tools has been helpful in just communicating to clients. So.
Okay.
Lori, in your analysis of the market, you used forward PEs. And if you use the Shiller PE, for instance, the market's about 25% overvalued. And that's taking a look at earnings over a cycle. And I'm just curious, why use forward and not something more historical?
Yeah, I mean, I think it was a simplistic analysis, but I also showed a 20% WACC in earnings. And I think it's really more of a piece to talk about parts of the market that are cheap. So if you do that analysis or you use my analysis, the one takeaway is the growth part of the markets, healthcare, energy, technology, some of those segments are really cheap.
Meg and Lori, it's what a contrast here in your presentation as compared to our luncheon presentation. I would say you two really provided a reality check, and for all of us that obviously are investing people's money, this is a pretty terrific presentation.
Thanks.
Thank you.
Thank you.
Mag, can you give us an idea as to your pick a portfolio and allocate it?
I'm sorry?
Could you just talk about the way that you allocate portfolios? What percentages are going to equities? What percentages are going to commodities?
The way that we absolutely take a one-on-one relationship with each client because everyone has a different risk tolerance, they have a different outlook. We look at their entire holdings, from personal to the assets that we manage to the assets they may have somewhere else. My personal bias is towards equities, but sometimes my personal bias doesn't carry the day. But my reasoning behind this is simply because we have seen over time, we see growth of capital. And with one of the instances that Lori had cited, where you've got Lowe's that's been buying back so much of its stock, we're seeing that every single day, companies buying back stock, and they're also increasing dividends. Those are the kinds of stocks that I want my clients to own. I cannot give you a simple answer to how do we allocate because it varies from client to client. And we have clients who have hundreds of millions of dollars, and we have clients who have a couple of million, and it's all important to each of them, and it's all individualized.
Just want to thank you for your well thought out comments and research. Also, in your practices, I know you just mentioned that you couldn't characterize the whole thing, but let's say you took someone that had maximum return, that they wanted, and they had at least 5 years before they needed any of the money. How would you allocate between cash and equities, for instance? And how would you allocate between the equities like international, small company, emerging markets, that kind of thing? Just give us some generic.
Who am I speaking
quotes.
to? I can hear
Roger
the voice.
Green, how are you doing?
Oh, I'm sorry. I'm looking over here.
So just cash, bonds, stocks, just generically, and then international, domestic, within the stocks, how much small, how much large, that kind of thing. If you had somebody say, I just want to make the most money in the next 10 years.
I would say cash would be less than 10%. There's nothing in cash right now. We do have some alternatives. I would have an allocation to equities of 60%, and then I would spread out the balance. I'm not high with fixed income right now, other than very, very short, so there's very little in there, and I'm looking at it as a parking place. As far as what sort of equities would I would own medium and large caps. We've not seen enough bang for the emerging market buck, although I think there's huge opportunity there, and I could be dead wrong on that. But I've been dead wrong when I've been in it, so I'd rather stay with the ones that have been winners. Is that adequate? Yes. Okay, you're welcome.
Sure. So growth-oriented portfolio, not a high need for liquidity. Was that kind of what you wanted me to outline? Not terribly dissimilar, very tipped to equities, but we do use hedged equity in a lot of portfolios as a substitute for equity. So in markets that are inefficient or highly volatile, we'll use more hedged equity types of managers, like in the emerging markets, which are tremendously hard to find, but we do have some managers we use there versus taking just total beta, because it's especially right now because the valuations are not cheap. However, as I said before, I think the liquidity could really provide a tailwind for those markets. So we have a fairly healthy position to large cap. We're overweight there. We're, as I said, really underweight to small cap, but we're tipped to equities. How we implement it, though, is in maybe a less volatile way. So small cap, we're hedged because we think it's a winners and losers market. Everything kind of went up. Small cap valuations are really stretched. The economy's not great. And so I think if you can find a hedged equity there, a manager there that can play both sides, it's interesting. So we are tipped to growth. We would be certainly tipped to equities. It's just how we implement it is different.
I have a question for Lori. There was one slide that showed the price to earnings ratio on the emerging markets was about 15% lower than the developed markets. Another slide showed that the debt burden of those developed markets was sky high compared to the emerging markets. But yet on your overweight, underweight slide, you were overweighting developed markets and underweighting emerging markets.
Good question.
Why is it that given those other metrics, you're so bearish on emerging?
As of the end of the year, we were slightly overweight developed non-U.S. because the valuations were really cheap there. But in Europe, we were hedging out the currency, which we still are through the use of a manager or managers there. So, you know, I guess if I think about it, if I can buy a large multinational company trading at 8 times, it has a lot of the characteristics that we described, I would want to own that over the long term. Providing that, you know, the majority of their earnings are coming from outside of the Eurozone. So that's why. We're bringing that back, though, because it's obviously run up a lot and the valuations aren't quite as cheap. But these are like small trims on the margin. Does that answer your question?
It talked to why you were optimistic about international development, but not perhaps why you were pessimistic about emerging.
Oh, we're not pessimistic. We're kind of neutral there, and we are accessing the emerging markets in 3 ways, through equity, through hedged equity and long equity, currency and debt. And we've been investors in currency and debt for many, many years. I think maybe like 12 years. And debt, the debt markets have really matured there over the last few years. So now we're more, it depends, it's country by country, depending on if they're ahead or behind inflation and a lot of other things where, you know, where you would invest. But we have currency and debt emerging market portfolios in that multi-strategy bucket. They're pretty significant.
Are you providing GIPS compliant reporting to your clients, and if so, why, and if not, why?
I wasn't clear. Could you repeat the question?
Are you providing GIPS compliant reporting for your clients? If so, why, and if not, why?
Are we providing GIBS reporting? We have a hedge portfolio and we have a large cap portfolio where, yes, we are GIBS compliant. And we have offered that because we just think that is what a serious portfolio should. I've lost a word at the moment. It's just, if you're in the institutional space, it is a requirement in our estimation. I'm not putting words in anyone else's mouth.
Yes.
Barron has asked me to ask you to provide one actionable item, perhaps, for the audience in terms of their advice practice. Do you happen to have one that you can?
I thought I just gave like 5.
Yeah.
But since I didn't start doing what Barron told me, which was to congratulate everyone for being invited to this conference and being Barron's top independent advisor, I wanted to ask again.
Okay, Meg, I have
All
to
right.
think. Go ahead.
I think I started in my presentation to say, think about something that we have spoken about in this past 45 minutes, and something that you're not doing, or you've not paid much attention to, and take it into your practice over the next year. I did talk about whether or not we should look at minerals as a separate asset class. Trust me, that is coming up more and more and more with your very large clients who are investing in very unique situations. But just think about anything at all that either Laurie spoke of or I did where you haven't been working, and incorporate it into your practice for the next 12 months. And let's revisit it next year and see how well that worked, or didn't it work, or what did it lead you into. Because the more we can introduce good ideas to our clients, the more money they will make, and the more referrals they will give to you. And the more that happens, the more money everyone makes. But the important thing is you are the cream of the crop. And as the cream of the crop, you have to stay cutting edge with what you do in addition to what you have been doing to bring you to this point today. And I think it's incredibly important that you really get out there and you really offer new ideas. And I hope to goodness I just answered your question, Robert.
I think she answered my, I guess I would say this. I mean, clients are looking for us to have confidence, as I said in the beginning, and whatever that takes to get you confident in advising them. It's really important because otherwise they won't do anything. And there are things that they really should do, and there's opportunities now. I think it's always really, really important to understand how your client views risk. And whatever way you can get at defining that is really important, and start there. Start with liquidity and risk, and then move from there.
Thank you very much.
Thank you.